Hi, today we're going to talk about derivatives. So, derivatives are financial instruments which derive their value from some underlying assets. There are two major categories of derivatives, the one which are exchange traded and the other one which are OTC, over the counter derivatives. In exchange traded derivatives, there is a centralized counterparty which is known as exchange uh, is there, and it settles transaction through clearinghouse. So exchange buys security from one party and sells security to another party. These party are really not dealing with each other. They have to be exchanged in the middle. So by having exchange, there are few benefits like it provides a credit guarantee to market participants. Um, the transactions are more transparent, and and exchanges are obligated to disclose their transaction to regulators. And to mitigate credit risk, there is a process called mark to market, like and the end of the each day, market participants they mark to market their position at settlement price, and based on the difference they post margin in their account. So this margin is called initial margin when they start the process, and maintenance margin is the daily margin which they have to maintain. Whereas over the counter traded derivatives, most commons are like forward contracts or swaps or some options. So these are famous over the counter trade derivatives. Exchange traded the future, and future is more common as an exchange traded instrument. In over the counter traded derivatives, there is no exchange in the middle. The counterparties are dealing directly with one another. So market participants like big dealer banks, they buy and sell customized derivatives in the market. It's relatively less regulated than exchange traded derivatives, and also provide more privacy to these participants. However, since uh, is not backed by exchange, so there is a credit risk involved. There are benefit to these derivatives. Derivatives provide price information, yeah, through the information discovery. It actually helps in correcting the underlying price, and we can derive the derivatives price based on underlying price. We're going to talk about it more. It allows risk to be managed and shift among market participants. So we talk about in CDSs or some options where we can combine these options with underlying assets, or we can buy credit default swaps on bond portfolio, which kind of provide more safety or ways to mitigate risk. It reduces transaction cost. Rather than buying the underlying, if you just buy derivatives, which actually little more cost effective. So more liquidity than underlying market because lower transaction cost and less capital requirements. There are criticism to derivatives like uh, since there are high chance the derivative value can go to zero when they expire out of the market, or so it kind of the behavior is somewhat similar to speculative or gambling behavior, because with the little money you can get exposure to get the exposure to get a very large exposure, and there are high chances we like in derivatives you may end up losing all the money which you invested. So it's a little risky. Complexity in pricing is not straightforward. You have to use some sort of a modeling approach like Black-Scholes models, or which we're going to talk about in later sections. destabilizing and systematic risk. So we know that the derivative were involved in 2008 market housing market crash. So the so it's very risky, and there are high chances the big losses what happened to 2008 market is spread across all other asset classes. So um, so they are in short risky. Thank you.